Welcome to the class. So today we'll just look at top-down approach, or you can call it multi-time frame approach to analyzing a pair. Usually, let me clear off everything I have on this chart so that it's a virgin chart. Now, the reason we go by the way of top-down analysis or multi-time frame analysis is on the higher time frame, like the monthly time frame, it gives you an idea of what the macro economy is saying for these pairs or for the currencies. Now we have to bear in mind that when we are trading pairs, we're actually trading the economy of each of these nations. Are you with me?
Yeah.
Yes, and what makes price move actually are forces of demand and supply. Basically, it's not just about forex. Every other market. What will move any market, what will make a market sell or not sell, is the forces of demand and supply. And these forces also revolves around, and what controls demand and supply in an area or in a country are socio-economic activities around that country. I don't know if I'm making sense.
Yeah.
Okay. So if you have watched the videos, you see me mention unemployment rates, GDP, and a couple of other economic factors that actually affect the movement of price. But why do we come back to the chart? The chart is more like the summary of all the effects on price. We just see it on the chart. Now, if you're looking at fundamentals alone, you find out that a lot of variables are acting on a particular pair. So it's not just one variable that is causing price to move. Let's take, for example, yesterday was NFP. On a normal day, when NFP occurs, you will see erratic movement up and down. But yesterday wasn't so. We could hardly even get up to 50 pips movement on some of the major pairs. The reason is not far-fetched. It's not just unemployment rate that affects price. There are other factors that are also affecting price, like CPI, like politics, like bank rate, and every other thing. So we'll not delve into that. Are you getting me?
Yeah.
So we'll not delve into that. So what we're looking at now is, how do I approach the market technically when I come on the chart? So the first thing you do is come to the monthly time frame. It helps you to stay on the side of the fundamentals. Now, when I say fundamentals, I'm not talking about daily news release. Daily news release is not fundamentals. Daily news release is like what they call it, checks and balances for already formulated economic policies, maybe in the beginning of the fiscal year or the beginning of the calendar year, depending on what time or period the policy makers decide to bring out policies. I don't know if you understand me. Okay, so let's look at Euro USD. So coming to the monthly time frame, what we'll be looking at first, what I look out for is, where is price coming from and where is price going to. In my own opinion, price comes from an area. If it's selling, if it's actually selling, that's if it's a downward move. If the immediate move is a downward move, it usually comes from a supply area to a demand area, since I mentioned that what controls the market is the forces of demand and supply. So what it basically means is that price will turn at demand zones. Are you with me? Price will always turn at demand zones. A lot of people confuse demand zones as support and resistance. No, demand zones are not necessarily support and resistance, because a support or how will I put it? A lot of traders draw their support and resistance. I think we talked about this last week, right?
Yeah.
A lot of traders draw their support and resistance the way they feel. So, but to be sure of where price will turn from, you have to start looking at exact demand zones or demand price or supply prices that price can turn from. That's why you can see me, I can point out and say, okay, these are the probable points or probable prices that price can turn to. So if it doesn't take this, it will take the other one. Are you with me? Yes. So now looking at this price, I will just point out zones. I believe you have watched the demand and supply, how to plot your demand and supply zones on the video. Or maybe we'll touch on it. We'll touch on it as we go on. You will see that this current move that is happening here, this is the current move I'm seeing, right?
Yeah.
This current move is coming from this monthly supply. It's coming from the monthly supply. Let me just find the text and label it. So it's coming from this monthly supply. So it's coming from this monthly supply, and I want to believe that it is heading to this demand area. Are you with me?
Okay.
Good. Now, you always hear me say that there are two types of traders in the market. You have the retail traders and you have the smart money traders. Now, retail traders are those that look at turning points, that look at support and resistance and trend lines as turning points. Are you with me?
Yeah.
While the smart money guys look at turning points differently. They look at demand and supply zones, or you can call it, there's a special type of demand and supply zone created by the institutions called the order block. We'll get into that when we get into execution, but let's just keep it at that. So now we have the two types of traders, the retail, the smart money. We are looking at how both relate with each other. Now, even with the smart money guys, there's also what we call the smart money retail, which is where both of us fall into. That is what I teach, smart money retail. Now, there's smart money institutional, or the institutions that trade smartly, and there's smart money retail. Are you with me?
Okay.
Good. So now, smart money retail, what they want to do is they want to copy what the institutions are doing. So what they do is they wait for the institutions to move, then follow the institutional footprints.
Okay.
While the retailers on their own side, or the retail traders, really don't care what the institutions do, or they assume that the institutions will always find a way to manipulate their trades and all that, and which is true. I'll tell you where those manipulations come. So they keep looking at support and resistance, and most of the times I've traded as a retail trader. I'm trading as a smart money trader, so I know the difference. I know the entry modes. I know the, what they call it, I know the way both traders think. That's why I'm able to combine both the smart money and the retail trading to know how they interwork, because both of them need to play in this market to make the market move.
Okay.
Good. So now let's look at something. A retail trader will be looking at this point. Are you seeing this?
Yeah.
This is a trend line. It's a multi-year trend line. Now this multi-year trend line somehow coincides with this demand zone, so making this place a confluence, kind of. You can call it a confluence. because both the retail and the smart money agrees.
Are all looking at.
Yes, are all looking at it. So somehow something is going to attract price to this point. Now, why is this so? Why is this so? Because Forex is a game of the majority. We talked about it the last time. It's a game of a majority. If you have 10 traders that believe, or you have 10 traders that are ready to stake $1,000 each on a pair, and 7 out of those 10 traders believe that this pair is going to buy, while 3 believe that it's going to sell, believe me, that trade is going to buy.
Yeah.
Because the people that have more money will win. Now, this is why the institutions win also, because they come into this market with large money. But even their large money is a problem for them. I'll tell you where it is a problem for them and how they try to solve the problem using the retail traders' money. So let's continue. It gets interesting. So first of all, we have a little idea of where price is coming from to where price is heading to. Do you understand?
So
yeah, go on.
Quick question now. So when you come on the monthly, what range of months do you try to look backward? So let me just think like a retail for a while.
Okay.
You know, you sometimes what's forecast? Do you look at what has happened in previous past, or you just look at in recent time? Where is price coming from? Where is price going to? You just look at the recent trend. You focus on the previous trend.
No, I look at the chart holistically, everything, just like I've zoomed in and I'm seeing everything now. We just looked at the movement, the current movement, but I'm going to now look at the structure. What actually brought about this movement? Is this a retracement movement? You know what we have here? We have both retracement and impulse in a trade. Now, we want to now understand, we understand that this is a move from here to here, but what kind of move is it? Is it a retracement move or is it an impulse move?
Yeah.
So now what will define the kind of move it is the structure of the market.
Okay.
I don't know if this is clear. Does it answer your question?
Yeah. Yeah.
Okay, so the first thing I've just identified is we have a move, and the move is heading from up to down. Now, bear in mind, if you have a retracement move on the monthly, is a serious trend on the weekly and on the daily, even the 4 hours. Talk more of the lower time frame. So even if this is a retracement leg, we want to consider it as a trend at the moment, because we are talking of macro level of the price. Do you understand? I don't think you understand. Do you? Or you have a question?
Sorry, I'm just trying. There's something you said that I'm writing, that when you have a serious trend on the monthly, sorry, a retracement on the monthly, there's actually a serious trend going down on the weekly, daily, and the hourly. So I'm just trying to write that. Sorry.
Okay.
That was a valid point.
All right. So that's what it means. Because look at this. Let's look at this first. Look at where price is coming from. From here to where price is now is a whooping 737 pips. Imagine bagging 737 pips when you make an entry around 1 hour or 4 hours. That you will be in serious money now.
Yeah.
You understand? So it's a full-blown trend on the lower time frame. That's why I said that. So imagine it goes all the way to this point. That's 1.345. I remember, if I check my posts of February, I remember when I forecasted this bullish trend on GJ. I forecasted it was 1,500 pips from February. I think that was February 1. From February till around July, we were able to hit that 1.5. But it had a lot of ups and downs. You have the waves coming in. I'll tell you what what brings about those waves as we go on in this analysis. But it was consistent in that direction, but with all the impulse and the retracement legs on the lower time frame. Yes, maybe after now I will share that analysis with you later on. I still have the photos. So now let's go on. So this is just what we have from monthly supply to monthly demand. Now, but what is this move? I want to know what type of move it is. Is it retracement? Is it an impulse? If it's impulse, it has a high probability of breaking this guy and going down. You understand?
Yeah.
If it's retracement, there may be lower chance of it coming here and turning around. So we need to find out. So we'll start looking at structure, macro structure now. Now, if it's this is FXCM, yes, this is FSCM. Now, if it's a Wando, you may not have all this price data up to this point. Maybe have it around 2003 or 2000. But these guys have enough data from 1994 till date. You understand? Okay. So, so let's look at this. So from what I'm doing now, the next thing I want to do is to start counting the waves. Just literally count the waves. I know before now you want to start drawing support and resistance. Time will come for it. I'll tell you the use for it. I know you've watched the video and you saw where I do support and resistance and all that. I'll tell you what you will use for it. What you will use it for later on. Okay, so now I'm counting my waves. Just 1, 2, 3. Let me call this some form of consolidation. It's just literally, I just want to know if I were doing the analysis myself. I don't need to bring out this tool. I already know where I want to point, but for the sake of teaching and understanding, that's why I'm using this tool to highlight the swings properly. I hope you get me.
Yeah.
Alright. So we have something like this. This one probably coming to this point. Good. So this is the swing. Now, there's a basic structure in the market, what we know. Which I have on those videos you were watching. It's either the market is making a bullish structure, or you call it a bullish momentum, or is making a bearish structure or a bearish momentum, or the market is ranging, right? So when you say a bullish structure, it means let me take this up so we have a free space here. When you say a bullish structure, we have the market making higher highs and higher lows.
Yeah.
Then when we say we have a ranging market, the market makes almost equal highs and equal lows. It may not be exact, but you will see it as almost equal. Then a downward trend will start making lower highs, lower lows.
And lower lows.
You see this thing we have here, it is the bedrock of success in trading. If you're able to understand this and the dynamics between it, you find out that every time frame has this. Now this is the basic, yes, every time frame, you experience it on every time frame, monthly, weekly, daily, or even the 1 minute, even the seconds. Now this is the basic structure. Are you with me?
Yep.
Alright. Now this is the basic structure. Now what we want to be looking at is there's a structure for a bullish trend. Anytime this structure is violated, you know that the market has decided to start going down. Now let me show you what I mean. I'll move a little bit. Let's say we have a bullish structure here, something like this, and suddenly the market comes here, makes a lower low, then starts carving something like this. Now at this point, if you ask retail traders, look at what they will tell you. They will tell you that they have a trend line here and tell you at the break of the trend line that the structure has been violated, or it's a break of structure. No, a trend line does not validate break of structure. What validates break of structure is the low, the last low before the high. Are you with me?
Okay.
Yes. This last low, you know this point here, sorry, a lot of points show up, but here look at where my cursor is. Can you see my cursor?
I see it.
Alright, good. This last low here is what validates a break of structure. So now it's expected that as price has been carving higher highs and higher lows, it should just come in somewhere within this place and also continue going bullish, right?
Alright.
Maybe come in somewhere here and shoot up again, or even come in up to this point and shoot up again.
Yeah.
But it failed to do that. So on the time frame which you are on, which you are looking at the structure on, if you are looking at it on 5 minutes, then if we have a 5 minutes close below the last low, it becomes a break of structure
On that time frame.
on that time frame, because you cannot call a break of structure when if you are looking at a daily trend, then you now come and see a 4-hour close below the last daily high and call it a break of structure. No, it is not, sir. I don't know if this makes sense to you.
Can you just come back with that last statement?
Now the statement is, if I'm looking at a structure on a particular time frame, example a daily time frame, and I have a break,
Yeah.
that's I've determined the last low before the last high on the daily time frame, then price starts retracing and I decide to switch over to 4 hours, still bearing this low in mind, and I see a 4-hour close below this low, it is not yet a break of structure.
Yeah, correct.
It can only be a break of structure when when there is a daily close below that level.
Below it.
Yes. Now the reason is this.
Okay.
The reason is this. You may have a 4-hour close. The next 4 hours goes back inside. Now retail traders will now see it as a manipulation of this level. I don't know if you understand me.
Yeah.
They'll see it as a manipulation of this level. But we'll talk about manipulations and how it happens, the dynamics behind it, and what really happens when manipulations happen. So now, okay, that was
so if I may summarize what you just said now.
Okay.
So the fact that you see a lower time frame break of structure does not imply that it has broken on the higher time frame.
Very
The higher time
perfect.
frame has to break structure before you can answer it as a break of structure, correct?
Very correct. Very correct.
Okay.
So when you are trading structure, let me now elaborate on this. When you're trading structure, you are trading structure based on the time frame you are on,
Yeah.
so that you don't go and over target. The reason for this is someone will go and take a low of daily or daily low as his target. He has entered a trade using 4 hours, then he will be targeting a daily low. Then when price gets to his 4 hours low, it reverses against him. Then you're in profit. All of a sudden, you've gone back to minus because you didn't take cognizance of the fact that you are dealing with a 4-hour time frame or 4-hour structure. So the only thing you can do, even if it's going to come to the daily low, you are expected to close up your trades or take partials at the 4 hours low. Yes, every other time frame now becomes jara or becomes an extra.
Okay.
Do you understand?
Perfect.
Sometimes you see it as 100% retracement. We'll talk about that later, Sha. So from what we have here, this becomes a break of structure because it has broken this low. There is a close below this low. So once you have this, your mind should be triggered that we are about to change direction on this time frame. You understand? On this time frame.
Yeah.
So, but there's something that happens. This is where smart money comes in. This is where smart money also plays with retail. Now, look at what happens. A retail trader, look at what a retail trader's mindset is. Before we go to the chart and see examples, now, a retail trader's mindset, there are two things they look out for. They have drawn their support and resistance, which you have learnt also, because I wanted you to have your retail mindset and also have a smart money mindset, so you know where retail liquidity. That's why I taught you support and resistance and all that, so you know where retail liquidity lies, because smart money will play with retail liquidity to fulfill their market. I'll tell you the reason for that. Now look at this. At this point, the retailer is looking at this point as his support, right?
Yes.
Now what happens is that they are either waiting for a break or bounce off of the support.
Yeah.
That's what a retail trader looks out for. So if there is a close below here, the aggressive retail trader will make an entry. This is for aggressive retail trader. He will make an entry, maybe place his stop above, maybe go to a lower time frame and see if there is some kind of a swing where he can place his stop and target to the heavens or whatever. You understand? Now what really happens? This guy may go on in his favor and keeps going down. That happens. Now, but majority of the times, look at what happens. It will start going down a bit, and to complete this break of structure, then retrace back and take him out. Then after taking him out, it starts going in his direction. If you have been yes, he will say it's manipulation. So what is the dynamics of this? So I will explain it in layman's term. Then we'll come back to forex. So what's the dynamics? Okay, this is the first part of. Oh my God, am I recording? Yes, okay, I'm recording. All right, I'm recording. So now this is the first part. Now the other part is where, if it is a conservative retail trader, he will wait for the break, then maybe look for a lower time frame retest of this zone.
Yeah.
And if some will even wait for another push, maybe a bearish engulfing candle. The ones that trade candlestick, maybe a bearish engulfing candle here, and I'll show you examples. There are live examples on this chart. I'll show you. Then maybe place his trade and put now, so that he can get a swing where he can hide his stops, right?
Yeah.
Now this trade still comes back and takes him out. Now look at the ones that will survive. The ones that have serious money that can afford to keep their stop above here. I don't know if you understand me. Now, the ones that can keep their money above the head. This is what textbook trading teaches you. It's going to teach you, because this is it's going to teach you chart patterns. Maybe it's about to form inverse head and shoulder, that you should keep it above here, or a break of a channel that you should enter. Once the channel breaks, enter the trade and keep your stop above the channel. Those things work, but look at what it's going to do to you. It's going to mess up the risk to reward ratio of this trade. Do you understand?
Correct.
And you will be in serious drawdown before, if this trade is going to go in your favor, before it goes in your favor. Now, forex, because you're dealing with real money, is not PS5 or PS6 that you're playing. It's real money. Now, when this thing starts going against you, if you're not a strong-minded person, you become scared.
You want to close.
You will close. Not even you want to close. And once you close, fear and the thing starts going in your favor. You'll be like, then another thing, you jump in again. It goes back again. You close again, and that is the beginning of panic trading. I don't know if you understand. I'm trying to make this as simple as possible and as relatable as. Yes. So you want to close. So now what happens? Now, if you have money, you can keep your stop here, but it messes up the risk to reward ratio. You may not even get up to 1 hour on this trade. Now, what is retail trading? What is really a retailer? Is someone that is willing to buy commodities or buy products at an expensive price. This is an expensive price. While a smart trader wants to buy at the best possible price in the market. So if you check the video, I said there is always value chain in every business. So that's what I was referring to. Now, when I said there is value chain in the business, it means that, okay, for example, I gave an example of a tomato paste business where there is the manufacturer, there's a wholesaler, there is the retailer, and there's the consumer. The wholesaler will always buy at a cheaper price and sell to the retailer, which continues to sell.
Yeah.
So now look at what we smart money do. We want to wait for it to come to this point. This point is called the optimal trade entry point, which usually coincides with, in short, is the order block. We will get to learn that when we talk about entry. So it comes into this place. We take our trade from here. Now, with the way you have taken trades here, you can easily sell off this trade, discharge of this trade somewhere here, which a retail trader that wants to wait for the head and shoulder to form, to complete, will now come and buy from you. Are you with me? Will come and buy from you. You are selling into them. So or he's waiting for 4 hours close. When you have, if you remember, you have bought and you're selling into them. It's just simple concepts that play out on the regular market also.
I agree.
I like to explain it this way.
So you are buying?
Yeah, go on.
Now, so you are buying at you're buying it at the demand zone, at the supply zone.
Yes.
While he is still waiting for his own conditions to get fulfilled.
Yes.
You're already in the market. You're bought already.
Yes.
You understand? At the time when he's about buying, when his own condition is being fulfilled, you're already in profit about selling.
Yes.
Closing out your positions.
Very true. Very true.
Correct.
Very true. So you can take out some positions and still hold it and sell as a retailer also. That's where you have some people that buy in bulk and still sell retail.
Correct.
But you must learn how to take out your profit at the point you are discharging the trade to the retailer, because at that point price can get back, equilibrium can set in. There's something called equilibrium in the market. We'll discuss that. Equilibrium price can set in the market and come back to take price to the original supply zone. This happened in USD CHF that I showed you guys yesterday. Maybe you go and look at it again. It's the same concept that happened there. So what is the equilibrium price? At this point, when you sell off to the retailer, it may become too expensive even for the person, for the final consumer. I'm using regular terms. Pardon me.
Okay.
Now, let's say the manufacturer buys this and sells to the retailer. Then the retailer now marks up a bit. When he now wants to sell, because of the state of the economy, the consumer now feels it is too expensive for him. You understand? And decides not to buy. So at that point of the market, there is beginning to be equilibrium. That's when you will now see some ranging in the market again at the point you're selling it off. That's why you see some ranging at the close of 4 hours, close of 1 hour. All these things are market dynamics. Hello? 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 Hello?
Hello?
Yeah, can you hear me? Hello?
I can hear you, Casey. Can you hear me?
Yes, I can. Can you see the screen? Hello? Hello? Okay. Can you see the screen?
Hello?
Yeah, can you hear me?
Yes, I can hear you and I can see the screen.
Okay. So if you have seen the screen, okay, let's go on. So from what we have here, it just explains what happens. You're buying here, you're selling at this point, or just call it you've gotten the commodity, you're selling off at a price because you bought at the most what they call it,
cheapest price.
the cheapest price ever, as far as this market condition is now. So this is what happens. Now you now ask yourself, why doesn't price respect here? Why does it go back into this zone? This is where you hear me talk about. Let's come back to the retailer. You hear me say most of the time that forex market is a zero balance market. Are you with me?
Okay.
Forex market is not just forex market. Markets in general usually want to take the form of zero balance. Now, what do I mean by zero balance? Before any transaction is completed, there has to be someone willing to buy and someone willing to sell for a transaction to be. So once you have an agreement between the buyers and sellers, it becomes a zero balance. You bring me 100 naira, I give you oranges worth 100 naira. It's balanced. It's an agreement. Do you understand?
Yeah.
Okay, good. So now let's look at this concept. What happens? Why do they push the market inside? Now there's something that happens. The only thing that will cause a break of structure is the presence of high volume. Do you understand? Is the presence of high volume. Now these guys, what is it that will cause high volume in the market? Is either someone that has large money, deposits money, or comes to participate in this market, then it creates high volume in the market, creating this push to the downside, right?
Downside, yes.
Good. Or there is a case of an event that has happened in the market that will create panic in the market, that everybody wants to now start buying or selling. In the case of Nigeria, when there's about to be fuel scarcity, everybody wants to buy fuel the same minute.
Yeah.
You understand? So I'm painting that as an idea. So now let's look at the case of large volume, where someone is about to put large volume in the market. Now let's look at something. Because forex is, let me remove these things please. Because forex is a zero balance market, and the market wants to maintain equilibrium at all costs, almost at every time. So what happens is that if there is an imbalance in the market, if there's an extreme case of imbalance in the market, I will explain imbalance. If there's an extreme case of an imbalance in the market, it can lead to the shutdown of this pair until it becomes a no trade period. You can go and Google this thing I'm saying, that if there's an extreme, what happens when there's an extreme case of an imbalance on a stock or a pair, it can lead to a no trade period for that particular stock until the market maintains back its balance, until equilibrium is established again. Now what is imbalance? You would have seen me use all these terms. Hello?
I can hear you.
Yes, we have left top-down analysis. I'm explaining some concepts to you, so when we go into the chart, you understand what is really happening on the charts, the way I look at it. Now this market has been brought to break a structure, meaning that these guys really want to sell. The institutions or the guys that have huge money really want to sell. That's one indication that they want to sell. But now what happens is that for them to fill up their order, they need areas, or they need a market that has enough. Let's say they want to sell, they need area on the market where there are enough buy orders,
Right.
to fill up their, to still create that zero balance effect. I don't know if you're getting me.
Yeah.
Okay, so now let's say they have pushed it down, and as a retail traders are already warming up to enter this trade at this point. Now what it means is that at this price, even the retail traders are looking to sell, right?
Mm-hmm. Yeah.
The institutions are also looking to sell. So who is going to buy from each other? So what it means is that at this point here, this is not a good area for the institutions to buy, to sell, because at this point it means that if they dump their orders here, they are going to have a lot of,
the market will crash.
yes, the market will create excessive imbalance in the market, and they don't want to do that. So it's not like they enjoy taking out your stock, or they just like it is a game for them. No, it's about making money for them, because it doesn't make any sense you come and invest in a market where you can't gain anything from.
Gain anything. Mm-hmm.
You understand? So they dump their money here, and nothing is going to happen. Sure, the market will just be here. You create unnecessary imbalance. Do you understand?
Correct.
Create unnecessary, but then they will have a lot of unfilled orders around there waiting to be filled. They won't make money. So what do? They want to look for area where there are buy orders, so that they push the market into those areas and sell, so that the buy orders will compensate for their sell orders. So meaning that a lot of their sell orders will be filled around here. Do you understand? So now you now ask yourself, how do they know that there will be buy orders around here? How do they know? So now this is the second phase. I'm taking time to explain these concepts one by one so that you understand why we will not rush into the market. You are not chasing candles. You're waiting for the banks to come and do their thing. And then I'll tell you where you make your entries, how you make the reason you make those entries. You understand?
Okay.
Okay, good. Now look at, for every time you put a sell trade as a retail trader, look at what it means. Okay, just a moment. Let me get this. Now let's say you have a sell trade here. This is a sell trade. Are you with me? Here is your stop loss. Now your stop loss is equal to a buy stop. It's a buy order.
Yeah.
Have we talked about this before?
Yes, we did that last week.
Last week, okay. So we are still in order. We'll continue. So this is going to be a buy limit. Good. So it makes it easier. So we'll just go. Yeah, this. So this is a buy limit, meaning that this is a buy order.
Correct.
So they are going to go into this. So around here will be a sea of buy orders, because somebody would have placed a stop here, some other person will place here, some will place around there. So this is going to be a sea of buy orders. You understand?
Correct.
So they go into those buy orders so that majority of their orders will be filled. So once they do that, they now sell. But in the process, they have taken you out, because that's your step. The buy orders are your stop losses. They have taken you out as a retail trader. So what we now do is, because their orders are still large, once they sell off, there will still be some leftover orders that have not been filled, which they will not allow it to go unfilled. They will come back to fill it somehow. They get the market to come and fill it and sell off again. So what we do is, once we have seen this zone where there are still some leftover orders, so that brings us to order block. So order block is, you just look at order blocks as leftover orders, leftover institutional orders. So the smart money retail now comes, places his trade here, because he knows that the banks will come back for their orders. In the process, he will fill up its order and start selling down. Yes, and start selling down. So you see that the banks will protect this zone with all their life, because their orders are here. They wouldn't want to have any form of drawdown because of how large their orders are. Imagine 10 pips drawdown for 1,000 lots. That is over 100,000.
That's a lot.
Yes, that's over $100,000. Imagine a lot size and larger lot sizes. You understand? So this is the logic behind this, placing your trades around the order block. So this becomes the OTE, or you call it the optimal trade entry zone. So I hope this is understood.
Yep.
It's understood.
Right.
Yes, I can still tell you another story. You know me, I'm a storyteller about why this is like this. A man, okay, let's use this so that when you remember this, you don't need to. Why I do this, so that you don't rush into trades. Look for the best buying price, best selling price. That's what will keep you in the market. Now, imagine a man, an orange market. Then you have someone. This orange market keeps running naturally. People come in, buy few oranges, go. Another customer comes, buys another one, goes. Then one big man decides that he wants to feed the community. Then comes into this orange market with huge huge money. Now let's say he comes in with 1,000, and the quantity of orange in that market, in the whole of the market, is just 500. What is going to happen? That man is going to create an imbalance in the market.
Correct.
So what's going to happen? They will give him the 500 naira worth of orange, but his needs are still not met. So that man can be likened to the bank.
Okay.
Do you understand? Now his needs are still not met.
Yeah.
He still has like 500 that he wants to, because of the people he wants to feed. Now what's going to happen in that market? The orange sellers now want to now start scamping around to see where they can get oranges to fill up his order. This is just to explain to you that every market wants to maintain equilibrium.
Yeah.
So the process of getting oranges from other markets or from other sellers is to maintain equilibrium, to fill up the order of the big man. You understand that? Now,
yeah.
There's this, imagine an extreme case where the sellers have now sold to this man, and for some kind of reason, there's no other market where we can get more oranges to fill up the man's order. There will be scarcity of orange. In short, that orange market for some time will be shut down until there's supply again.
Obviously.
So this is what I told you, that once there is a critical case of imbalance in the market, it can lead to a no trade period. I hope this makes sense.
Okay.
I hope it makes sense.
Correct.
All right.
Yeah.
So let's go back to our chart. With this background, when we look at the chart, it becomes a little more clearer to us. I believe that. So you see what I drew here? It's almost like what is happening on the chart. You understand?
Mm-hmm.
Let's look at our chart again. So we have all this trend now. Look at what is happening. Now I want to look at this leg. I want to look at this leg. You see this leg, huh? Are you with me?
Mm-hmm.
Okay.
I'm trying to look for a push-up.
No, have you seen this arrow that I drew?
Yes.
Okay, that's the leg I'm looking at. This move to the upside.
Okay.
Okay. Now, so what it means is that I've taken out the arrow. The last high that was achieved is this, right?
Mm-hmm.
Then what is the last low? This is the last low. This is the last low that was achieved before the last high, right?
Yeah.
So let me just extend it a bit. Now with what we have here now, it means that at any point this low is taken out, it means that we are looking at a downward structure. Price should be heading down.
Yep.
Right?
Down.
Price should be heading down. So let's look at this whole thing holistically. There are things that has happened around here which I will not explain now, but let's just look at simple structure where the break of structure has happened. This is the point where price broke structure, right? Can you see my chart?
There is a little bit of delay.
Okay. Hold on. Let me use a circle to get it. So if you see the circle, you know you have it. Do you have a circle?
Yeah.
Can you see the circle?
Yes.
Alright, good. Hold on a bit.
I can. So that's the point. That's the break of. Okay.
Yeah, that's the break of structure because that low has been broken.
Okay.
Now, this low has been broken, constituting a break of structure, and the only people that can do this is the presence of high volume. It's high volume that will cause all this massive sell after some rigorous buy. You understand? Now a sudden sell that brings price to the downside. Now let's explain all these things we have been talking about. You see, this thing I'm talking about here now happens on all time frame, even the second time frame. It's just for you to identify the trend, identify the break of structure, and trade according to that time frame. But most times it is best to trade in the direction of the higher time frame. I will tell you that. Maybe I don't know if we can do that in this class because I have other classes. When we come to a second class, we'll talk about, or that when we talk about the fractal structures and the major structures. So there's a lot to learn, sir. So now you see what happened. This is a break of structure. Let me just label it with a text. Break of structure. So this is a break of structure here, or you can call it break of market structure. So what now happens? Let's still go back to our story. Now the retailers now kick in. This is where the retailers will now, the first set of people are the ones that look for buy.
Yeah.
Look for a sell at the break of structure.
Sure.
Yes.
Structure. That's the aggressive one.
The aggressive one. Maybe he's targeting all the way down. I don't know where he will be targeting now. Maybe place his stop somewhere. Maybe look at a lower time frame structure or something and place his stop. Now, price now gives him sign that is going down. He's happy. At this point, he is just 1 hour. He will not be. It's not even up to 1 hour. You understand? He won't be that satisfied. You understand? He won't be satisfied because this is just 1 hour. Some trades will not even run up to 1 hour before they start retracing. You know, this 1 hour is because of where I placed my stop. If I had placed it maybe somewhere here, yes, it's so. Now let's just assume that he's 1 hour up. He may not want to take his profit. He wants to, maybe he's targeting all the, because he has seen this break. Look at the mentality. The mentality is that once this guy is taken out, the next place is this zone, because he will have his support and resistance all the way to this point. Probably he's a zone to zone trader. You understand? So he will leave this trade here, and the thing will give him some profits because he's targeting here. Then come back to his stop. Maybe at the stop he will take out, or when he starts going here, he's already in drawdown. He's afraid, he takes out it. If he's not the one that usually gets afraid, the trade takes him out. Are you with me? Now, who is the person that will survive? The person that will survive is the one that has means of putting his stop all above here. You understand? This is monthly time frame anyways, but imagine when we're doing it on weekly and all that. But you see, it still messes up the risk to reward ratio. You will now be on drawdown, then the thing will now start going down, come back again. For how many years the trade will be going? If it's in 4 hours, maybe for so many days, it will go in your favor, come back into drawdown, go in your favor, come back. You understand that kind of thing?
Yeah.
So you may at the end of it, why I'm saying this, I've experienced this also, and this prompted me to start looking out for there has to be better ways of making entries, that this thing doesn't look like it's tedious, and so you understand. So
yeah,
because I found out that yes, I will analyze the market. I'm very analytical when it comes to things like this. I will analyze the market. I know where the market wants to get to based on my previous ways of trading. But I make my entry, it comes back, it takes me out, and still heads in that direction. You understand? I now resulted in it can force you into, I'm just trying to poke your mind, it can force you into deciding not to put any stop again. See, since you know that it will go up and come down, but trust me, my brother.
What if he sweeps your account?
And there's this belief that anything that goes up must come down. Sometimes things that go up don't come down because you may be wrong in your direction. So you end up blowing your account. There are other people that will have this ideology of use the lowest lot size possible. Use 0.01. Place the trade. Don't place stop loss. That the banks are seeing your stop. And once they see your stop, they will come and hit it down. I don't know if you have heard all these things.
Yeah.
They see your stop. Once they see your stop, they will come and hit it and go your direction. No, that's not the way. They just know the retail mindset. You understand? So
yeah.
So let's go on. So what happens? This guy is taken out. This particular one is taken out. Now look at another person, another retail trader. Let's be taking this so that you see where the transition is. So smart money now knows that your stop is here. They are coming for it. Look at another one. It comes, they retest. The retest guy, and they want that there are people that once they see the retest, they want to now put a counter trend line. Are you with me? And now say when price comes out of the counter trend line and breaks it, are you with me?
Yeah.
Maybe they go to a lower time frame and say when price comes to a counter trend line and breaks it, I will enter. They will now come here, make an entry somewhere here. Are you with me? And place their stop above here. Now the ones that don't understand what there's something I explained to you called the equilibrium price, where smart money sells into the retailers and equilibrium sets in and price reverses. You understand? Now maybe they don't understand the equilibrium price. They are still looking at this is 0.6. They want to shoot all the way down. Price comes back here and retraces back and comes to take them out because they have decided. They said that this is now a double tops for them.
Double top.
You understand?
So they're anticipating going down.
It's still going down. But price comes and takes them out. These are the sad stories you hear. Then they will not tell you Forex is a scam. So let's look at this. So now what happens? What really happens? Anytime there's a break of structure, it is the bank, especially when you see this move. If you remember what I explained about demand and supply zones, that before a break of structure, the banks will they give this indication. They actually, if they want to sell 100,000 units, they may just dump 10,000 units to create this break of structure, to give that illusion in the market. They don't dump all their money at once. It will crash that market. You understand? Anytime the banks don't dump all their money at once. They may dump it like once, twice, 3 times, just to ensure that there's still rhythm in the market, but at the same time they are making their money from the market.
Yeah.
So now they have dumped some part of it, creating this break of structure, luring in traders, retail traders. Now, but at every point they do this, they are going to create some imbalance, and before the imbalance, there's going to be some leftover orders that are not filled. Do you understand? This zone now becomes the order block, or where the bulk of the orders are, the price will return to. Do you understand me?
Yeah.
The price will return to. So what happens is that you, as a smart money guy, you now start looking for the order block. Now if I go to a lower time frame, you will see that this is a supply zone, or you can call it an order block. An order block is actually a special type of supply zone or demand zone where bank or institutional orders are placed.
Okay, quick question for you now. How are you able to know that that top now is an order block? See the fact that there's no, it's just from the top that we can see something like an institutional candle.
Now, I will not know whether it's this place or this place. So what I usually would do is, I am now dealing with, this is what brings in the probability in trading. I'm dealing with something. First of all, I will see this. I will see this particular one. I will mark it out as one point, possible, probable point that price will come to. I will either say that I will take price from here. I'll take orders from here. You understand? And wait for price to come here. Or now I can also look at, okay, let's say let me see if there is a form of confluence that could occur. I will now look at Fib. Are you with me? I'll bring out my Fibonacci, plot the Fib, and now say, okay, let me see if there is some area where there is some level of confluence. You see that Fib is here. If I now go to a lower time frame, I want to look at a lower time frame now, like the week. I first of all go to the weekly. You see now, this is now when I start scaling down. So I scale down to the weekly, and voila, there's an order block here. Can you see it? Are you with me?
Yeah.
This is the weekly order block. So I can now take this place also, and also have my trades here. So I'm going to have pending orders here and have pending order here. Now, why would I want to now take? Is either I decide to leave this one and take this one, or I take the two of them. Now, what is is it that since I know that price could come to this place, do I intentionally want to lose trades here? No, I don't want to lose trades here. It's just that I know that price could come here. Is a probability. You can call it 1:2 probability. It's a probability that it can come here and start falling, which actually played out, or it will break it and start coming up. So now what do? I am now working with risk to reward ratio. This is where risk to reward ratio comes into place. If I take trades from here and place my stop maybe above here and target down or target the next liquidity, I find out that I'm making maybe 2R or even more. If I go to a lower time, if I refine this trade now, and we'll talk about refining entries, and now see that I have like 3R in this trade. If I check this one, I find out I have. This is why you don't need to overtrade. I find out that I have about 3R also. I'm just arbitrarily. Are you with me?
Yeah.
Okay, good. Now, what's the probability? The probability is that price will come here. If it doesn't respect this zone, which sometimes, if it's a demand zone, it will, even if it's not going to respect it, will fall a bit, give you an advantage to break even. You understand? Before turning to come to this guy, which is what it is actually doing, which I feel that's what it's doing. It will come down here, then come back to take this point at this point before falling.
Okay.
Do you understand? So now it takes this point and starts falling. I've made money from it. Even if it's at 2 hour or 1 hour, I'll break it. Once I have a probability, if I have orders or I have imbalances above my former entry, the first entry will be a very sharp entry for me. Once it comes and I see a drop, I break even sharply.
Sorry, come back with that statement. Once you have an imbalance above your entry.
Yes, above my entry.
I have just like in this case now.
Yes, in this case. I know I have other blocks up there where it can come back to, or you can call them POIs.
Yeah.
Now, once I know I have this above here, I can take this trade here. Once it goes in my favor, even if it's 1 hour, I break even, because I have the notion that price can actually turn back and come for this one here. Do you understand?
I get your point.
This thing happened last week on AUD USD. There were actually 3 points. The first one played out. In short, it played even 100 pips. Now it has turned. It's heading for the second one. So imagine that you had a stop of say 30 pips. You already 3 hours on that trade. So you are dealing with probabilities. So this thing, because you are buying, one thing a smart money trader has to do is that has to remember is that I am buying at a cheap price. I don't need to spend so much money. I don't need to risk so much. You understand? Reduce your risk. Reduce your risk. It's not like a retailer that is buying at this price. The only time he can make tangible money is when he puts in maybe 20% of his account or even 5% of his account into a particular trade, which can still come back and fail him.
Yeah.
You understand? But this one, you can decide to. Sometimes I don't even go up to 1% of my account. But you can decide to keep it at 1%. Do you understand? So that if this fails you, you take the next one. Or you can decide to leave this one and just take trades from this one when all these other ones have been violated. But just know that this one may not be violated. It could just be this one that will start pushing it to the downside. Then when that happens, you want to now FOMO into the trade. You understand what I mean by FOMO? Fear of missing out. When you see that it has taken this one, you now want to jump into the trade. You've just messed up that trade. Maybe when it has come down to this point. You understand? You just want to jump into it. No, don't do that. If a trade doesn't come to your POI, leave it. There will be other trades.
Yeah. You never miss a trade, right?
Yes. There will be other trades that will come. Even that particular trade can give you a second leg. There's something called order block 2.0. I call it order block 2.0, where it gives you the first entry. Then as it's going down, it gives a second point of entry. If you wish, you can take it. So I don't know if I'm making sense, sir.
Yes. So let me just quickly recap, because I'm trying to follow this structurally now.
Yeah.
So from the monthly time frame right now, because what we've been able to establish now, you establish your buyers from this monthly time frame.
Yes.
Look at the market structure of the monthly time frame. Now scale down to the weekly time frame as well. We'll see where we break structure.
Yeah.
Able to mark out your point of interest. So, but I'm not saying us come down to like, okay, let's come down to like, I know we are here, we're demystifying everything, but can we now come down to like, let's say, the daily now? What do you look out for when you now go to daily and all those things?
Yeah.
Are there things you look out for?
Yeah, we are going. It's still the same concept. We are going down. We are going down. So what this means is that from what we have here, we have probable points, this and this. So now, this particular one has a probability of coming to this place. Now, anytime you see a trend line or support and resistance, just know that that particular zone is retail liquidity. That's where smart money wants to come and take up their stops and do what they want to do. So the dynamics of that area, so smart money may want to come to this place from what we have. So this now defines our move. You understand?
Okay.
This defines our potential move, which I'm looking at as potential move here to maybe come back and take orders from here, then fall. Do you understand? Do you understand what I mean? Hello?
Can you hear me?
Yes, I can hear you.
Hello?
Yes, I can hear you.
How you now use support and resistance and trend line come?
Hello?
That's okay. This is where retail are trying to.
Yeah, that's where retail is trying to enter the trade.
Exactly.
Hello? 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 Hello?
Hello? Yeah, I can hear you.
Okay. So this is where retail is trying to enter the trade. That's how I'm using. You see how I'm using the trend lines, the support and resistance, but I know where my entry points are. So I know what is going to be manipulated. So I can call this liquidity. Hello? Hello? Hello?
Yeah, I can hear you.
Okay. So I call that place liquidity zones. So are we able to get to where we are now, right? You're with me here, Abi?
Yeah. Yes.
Okay. So let's go further down. Okay. So now we're looking at price coming to this point. So this gives us our primary move. You understand? This gives us our primary move. So we should be looking at how to take advantage of this move from here to here. How to take advantage of this move from here to here. This is now when we can now go down to the daily time frame. We can also look at this. We can now come closer to the recent price action. I want to remove this. Okay. Let me remove this too. And this. So let's look at the recent price action. What is happening currently? And we can also, just like we define trends on the other side, we can come and define trends here also. Are you with me? Good. We can define trends here. Are you with me? Good. So with what we have here, this is the weekly, huh?
Yeah.
Now what is the last high? This is the last high. Same piece.
Last high.
Yes. This is the last high. This is the last high. Why this is the last low? You must get it at the week because we want to be sure that we have a close. You understand? So once we have this close, we are good. On this structure, is it up to 1? Yes, we have a close below it. I intentionally put all these angles so that I'm sure that I'm dealing with a straight line. Are you with me? Yes, so let me push this up. This line is thick anyways. You can, but you see that we have a clear close. Actually, the first one closed below, the second one, the second week,
has opened.
Yes, has opened and closed below it. So it means that there is a break of structure here.
Correct.
This becomes our new break of structure. So it confirms to us that we are going down.
Down.
Let me use BOS so that when you see BOS, you understand what some other places you see BMS, right? So BOS now it means we are going down, but now the retail is about to be chopped again. They are going to jump in and probably put their, the ones that have money will put their this thing here. And target all the way down. This one is even fair. This is 1.5. It's just normal concept in market. If you are a retailer, you will buy at an expensive price. You are not expected to make so much money as a retailer. So 1.54. So let's go back. Let's now look at, okay, what is the possibility? What happens now is that this guy has a, what is going to happen now? He will be looking for ways to return to an order block. It will find a way to return to an order block that broke this structure and sell down. So that's where we're looking to make our entry, somewhere here. You understand? So how do we find the order block now? I have looked on the weekly. I'm not seeing anything that look, because I want to see a clear. Usually how I define my order block is that I want to see what they call it.
Institutional candle.
Institutional candle, yes, institutional move. So I can't see, these are institutional moves anyways, but I can't see it clearly here on the weekly, just like it happened on the monthly. You see, it's like history is about to repeat itself from what has been happening, right?
Okay.
So we just go to the daily and see whether we are going to see, and I'm seeing something marvelous or something sweet. I'm seeing this. At least this one will work. I didn't even know it. Are you with me? This one, even if it's not going to, now this is oh God. See, it's the same thing that happened in the past though. Now there's another one up here, which is the one for that one up there that has not been tested. You understand? So there are two. You take your chances on this and take your chances on this. Definitely before price will want to go all the way up, it will respect this place more. Even if it respects it and comes small here. You see these 59 pips. By the time you refine this other block to 30 minutes, this 59 pips alone can give you 40, what they call it? 4 hour.
40 hour.
4 hour or you understand what I mean? So now let's look at refining it.
Yeah.
Let's look at refining it. Let me remove all these things. So you see how we are breaking things down, and we are even actually.
So let me hold on. Let me just get that. So if I come, we came down to the weekly.
Yeah.
to the weekly, you
Yeah.
cannot get the clear institutional candle.
Yes.
Right?
Yes.
That's our point of interest. So you can now break down to look for the best time frame that will give you the point of interest.
Yes.
Correct?
Yes. That's what we're looking for.
Okay.
Good. Now another thing
Yes.
No, go. Please feel free to ask your questions. I'm always willing to answer. Please.
No, that's fine. That's fine. So let me also get something right.
Yeah.
I can see this institutional candle here. What about the one that is just directly, just 2 steps above it?
This one.
I don't know that you're seeing that one.
This one, or this one?
The one at the middle of the one at the your cursor. I can't see your cursor.
Which one are you talking about?
Because if I were to take now the one where your cursor is now,
okay.
That one that looks like that inverted hammer there, and that spinning top.
Here.
That green candle that.
Can you point the price? Point the price for me. Just tell me the price. Look at the right side. Just
somewhere between 1.195.
195.
This is
here. You mean here?
Yes.
Okay, but this is not an institutional candle now. It's not on the daily. What I want to see is this move, this engulfing. This is not engulfing.
Okay. So So what you want to see is an engulfing, the green candle before the engulfing candle.
Yes. This is the engulfing. So I want to now know whether this is going to hold. Now, if you look at something, there is some kind of confluence also around here happening. So meaning that here, there could be, when price returns here, it could just take up some level of confluence and come down. So now are you with me? There's a trend line here, which some retailers will be selling at this point. Are you with me? Some retailers will want to sell at this point. So, and also there's another block. So it makes this place a confluence. Now what we'll now want to do is, in order to take full advantage of this, I want to look at refining this zone. Now, why do I refine this zone? I want to see the actual.
This your current order block now.
Yes,
right?
this one.
Yeah. Okay.
Yeah.
Okay.
Now, why do I want to refine it? I want to see the actual imbalance, because what price is coming for is not just this box. Price is coming to fill up an imbalance that was created, like we talked about.
Correct.
Why will price come all the way to this point? It's because of this huge imbalance. This is a huge imbalance. Price will always come for it.
Okay.
You understand? Price will come for this imbalance. Now there are times when if I want to counter trade, if price enters an imbalance like this, I'll find a way to counter, because I know that once price enters an imbalance, there's nothing holding it to get to the end.
Okay.
Yeah, but
so you now counter trade it to the other block.
To the other block. Especially if I see that the imbalance is juicy and I have where I can hide my stop.
Okay.
You understand? Like if price comes into this place now, I know that this is a daily imbalance, 110 pips. Anytime price gets into this place, it's going to run.
Okay, because it's trying to fill an imbalance.
Yes. So that's the story for another day. Anyways, let's focus on what we are doing. So now I want to see the imbalance. Even here is looking like Okay, let's go to a lower time frame and see if there is actually an imbalance, because here it looks like the imbalance has been filled. What is usually an imbalance?
Filled, yeah.
The distance between this green candle, green candle wick. Let me remove. Okay, it's not been filled though. It's my line. So you see the small imbalance. Oh God, it's going to come. Forget it. Let me remove this thing so that you will see it. I will use line and make the line quite small. One. You see this? That's what price is coming from. Are you with me?
Yeah.
You see this space here? This is what price is coming to fill. This now, when I want to refine it, I want to now know whether this imbalance further pushes inside here, or this is the nearest point of the imbalance.
Okay.
Are you with me? So price will fill this imbalance and come down. So let's look at it, sir. Then I will show you how it's going to deal with the retailers. Whew. I think we are getting somewhere.
Yeah.
So you see, this is what I do on the weekends. I take my time to look at these little minute details, then I'll place my trade and go for the week. You understand? When anytime price gets to that point, it will not do its magic. Like the one I placed on Euro GBP, I didn't even know when it clicked, but the way I placed the trade, it came, took out my first trade as on profit, then the other one broke even. And that when I now saw it, I saw that the first trade has been closed. The first immediate trade I usually close for my break even. Then the other one was just about, I now broke even, brought up my stop because of the way I saw the movement. Then it came and took me out on break even. So that's the way smart money helps you to break even fast. You understand? Yes, yeah. and risk less. Yeah. Let me show you what is. You see this one here now. There are some retail traders that are on this trade that have sold. You understand? Up to this point, they are selling it because of this break. But if the person is targeting all the way that he may not have even made up to 1 hour, then he's waiting for it to keep falling, then he comes back and takes him out. He's sorry, but let's go on. So now you see we have clearly defined the imbalance. Look at it. I usually represent it with an I, something like I, like this. I is as C.
Okay.
Yes. So anytime you see me put something like this, know that is the imbalance. So now let's refine. So let's refine to 4 hours. First, I want to look at 4 hours chart. What is happening? Now on the 4 hours, I can see what I will keep constant is this high, because this is the highest point of the order block. I'm not going to move it.
Okay.
But the low, I want to what I want, I'm interested in is finding a way to bring in the order block higher, so that I will make more money from it. Are you with me?
Okay. So you want to see how far this imbalance can be put, this imbalance can enter into the order block.
Into the order block, yes. So you now see that in 4 hours there is this one also. So it helps me. Let's check what the initial. This was 50 pips, huh? The order block, 50.5 pips. Now I've see another bearish engulfing candle.
Yeah.
I move it further.
Inside that one.
Yeah. So you see that the imbalance space has increased from here. This is the last red candle to here. Are you with me? So price is going to fill up this imbalance. Now this is 4 hours. Let's see how much we have reduced it. If you see how this will affect your risk to reward ratio, you will know that it has come into 40 pips, right? Now let me show you what 40 pips does. If you were using one lot size, you see this move, this 10 pips that you have saved yourself is $100. Do you understand? Now imagine that it falls all the way down. With just a move to this point, you are already 1.5 R. This is 60 pips.
Okay.
Now this is what I call optimizing your entry.
Sorry, hold on. So can somebody still refine this other block further?
We are going down now. We have not finished. Sometimes I can go down to 3 minutes just to see the place where this is going to.
Okay.
Do you understand?
Good.
So let's go to 1 hour. Let's just see what can happen. We want to look at the last point, because it's the last point that price will come to actually. 1 hour.
You will still leave your this thing constant, right?
The top, because that's the parent. That's the parent order block.
Yes.
So you see that 4 hours and 1 hour, really there's no much difference, but the green candle is there. You understand? Are you seeing it? So this becomes the immediate imbalance now. It's moving from here to here. It's now, look at the immediate imbalance. It's now this green wick and this red one. Are you with me?
So sorry, hold on, Casey. Going left, looking left, just if you're looking left now, this other green candle now that has this bearish engulfing, why are you not taking it into account?
This one?
The one, no, not going left too much. We're still within the other block, in the other, yes, that one.
This one? This is not a bearish engulfing
candle. Green candle.
Let me open it up. So let's look at the bearish engulfing candles we have. This is one, and this is the latest one. Are you with me?
No, sorry, I can't see your cursor now. See the one I'm talking about here now. This one, just the third candle.
This one.
The third candle that entered the 1, 2, 3. The third candle in the other block. Inside the other block.
This is the last one. Can you see my cursor? Let me use circles.
I've seen your cursor.
Okay, let me just mark all the. Let me mark all the bearish engulfing candles we have here within this place. So you pick the one. This is one. The next one we have here. This is not a bearish. There are only two.
Exactly, this one now is the one I'm talking about. This one now you just cycled.
This one.
Can't I adjust it up? Yes.
We'll come to it. It's a consideration I'm making. But the thing is, I want to look if there is any form of mitigation. This looks like it has mitigated. This red candle here now looks like it has mitigated this one.
Okay.
Do you understand me? We'll get to mitigation. We'll talk about mitigation later. Okay, let's talk about not later. Mitigation is just closing up of imbalances. When this one was formed, this candle came back, closed the imbalance. So the latest imbalance we have is here. Do you understand? So but we can still go further down. I'm still keeping this my top above here. It's like we are moving it up or something. Did it reduce? Oh, that's.
I don't think so.
Okay, it's okay. So it's 38 now. Even a retail trader, even someone that has $100 can trade this one now. If you use 0.01, you'll just be risking $3.8. You understand? But at 50 then it may be difficult for you to trade because you'll be risking up to $5 if 0.01. But let's even see whether we can refine it further. 45 minutes, because we may see something interesting. This is why price will just come to my pair and pick it. So you see that one you were talking about, you see that it's kind of filled. The imbalance came, this one came back, filled it. You understand? So we are still maintaining 45 minutes is still maintaining 1 hour.
Yeah.
1 hour,
no space.
No space. Let's go to 15 minutes. So, but if I do all this and get to 1 hour, maybe from a daily, and I refine to 1 hour, and I see that I can just stop at 1 hour and take it from there. You understand?
Yeah.
Now look at this other one. This one is where it's still that same one that we were talking about. You see it? Now it looks mitigated, so I wouldn't want to go up here. You understand? For this one, it looks like it has been mitigated because price can just come up and fill this last imbalance and start coming, and this is when I miss it by just few pips because I am being too conservative. Do you understand? But if I see that it's clear,
no, just come back. No, hold on. Come back with that statement where you missed that few pips.
Yes, this is where I miss the trade with just few pips, because let's say I bring up this because of this one, it has been mitigated somehow. Are you with me? With this candle. Yeah. Now price now comes back, returns back into me. And fills up this imbalance here. After filling up the imbalance, then it starts falling. Then you now see that I've just missed this trade by this space, and this space is not up to 2 pips. I've had cases like that. That's why I started learning how to refine other blocks based on the imbalance available. Some people will take the whole daily trade so that when it comes, it goes into them maybe 13 pips. Then you're on drawdown of 13 pips. You understand? But with what I'm doing, you have fewer drawdowns. You understand?
Yeah. So, yeah. Your drawdown is small.
Yes, it's small. You have lesser headache to deal with. If price ever comes and takes, I have a friend, I keep saying it. Once he does this, most times he will just keep his stop somewhere here, because he knows that if price ever takes up the imbalance and decides to start going up, that means he's looking for another imbalance up there. He's not respecting this one. There's no need. So what happens to him is that the trades he will get now becomes very, very profitable trades. You understand? Just moving.
Sorry. How does he do that? You said if price. I thought if he takes him out here, he's already at loss now. How would he now? Or is he going to keep another 2 positions open?
No, that's not what I'm saying. Is if he comes, he keeps his stop maybe above here. Then if price ever comes to take him out, it means that this block did not hold. But anyone that holds becomes a very profitable trade, because his stops are usually very minimal.
Okay.
So this is what, maybe we'll just stop here. 30 minutes. 1 hour will be ideal for this trade. Unless we see, I don't think 15 minutes. Will this price go? That 1 hour is the imbalance. We have actually found the last imbalance that needs to be filled. You see, there's no other one. This one also was filled. This one was filled here. So this is about
nothing there.
Nothing there. This is 15 minutes. So this is about the point. Maybe if he wants to just peel and come and retest this zone again, but the thing is, when it comes in, you have lower drawdown, then comes in and gives you some. At least most of the time, when it feels this imbalance, it will fall and give you up to 1 hour. You can quickly take out some profit, break even, do whatever you want. If you want, you can. There are different ways. When we get to risk to reward, what they call it, when we get to trade management, there are different ways of breaking even. One is either you come here knowing that it will start coming down. You can decide to take out, if it has given you 1 hour, you can decide to take out 50% of your trade and still leave your stop here. You understand? So that if it comes back to take you out, it is just coming to take 50% that it has given you. You're not losing on that particular trade. But if it now goes further down, believe me, if it goes further down and gives you 4 hours, you would have made 2 hours of the initial 1% you reached on that trade. Do you understand that?
Yeah.
So this is one way of breaking even and still leaving your stop here. When you say you have broken even, it means you are not on any loss. That's the meaning of breaking even. I don't know if you understand me, sir.
The last comment you made about still leaving your stop there and you are still broken even, but you would have taken a percentage of your account, right?
Yes, you would have taken 50% of your account. Now, if this is 1 hour, let's say this trade was able to come to 1 hour. This is 1 hour here, and you take 50%. That is, let's say you reached 1%, and you take 50%. That means you have taken 0.5% of your risk, right? What is left here now? The risk that is left here is still 0.5%.
Yeah.
So you can decide, so that you don't spoil the trade. Maybe it will want to come back, retest it, and start coming down again. You still leave your stop above here.
Okay.
If it now comes back to take you out, it will just take out the 50% that it has given. Yeah, 0.5% that it has given you.
Yeah.
Keeping your account safe. Okay. But you will make money if this thing starts shooting down. If it becomes one of such trades that can go into 5 hours, 6 hours, 10 hours.
Yeah.
I don't know if you understand me.
I get your point.
Yes. Now the other point is where you break even, then bring your stop to entry point, or just a little past. Yes, or a little past entry point, where if it comes back, it takes you out, then you would have made 0.5% of your account on that trade.
Okay.
You understand? But
yep.
It's now left for you to decide how you want to manage that trade, depending on how the price action is playing out. But the basic thing is, the first thing that goes into your mind as a trader is account safety. So we've really talked about, this is full analysis. So at this point, we have got to the point of entry. Yeah, go on, ask your question.
Yeah. No, I was going to ask now. Okay, we're just going to get to that point of entry now. So my target right now is going to be one, the imbalance that price is coming to fill, and then secondly, I'm also having my eye on my POI.
Yes.
The point of entry. This other block there too.
Yes. Yes.
Right.
Yes.
So is it a possible? Okay. So price. There's also a possibility that price can also violate the imbalance and actually go for the other block as well. Correct? Before going down.
Yes. No. Ask me that question again. Sorry. Let me get you.
I said there's also the possibility that price can come and violate it will not respect the imbalance, but it will respect the other block before going down, correct?
Yes. Usually to come other block means that there are others here. The only time it will not respect this other block is if there are actually no others here. But most of the times, if this happens, there will be leftover orders. For imbalance to be created, see sir, for imbalance to be created, there is leftover order. Because the meaning of imbalance means that there is leftover order. The only thing we are now wondering is if these orders that are left are enough to drive price all the way down.
Okay.
I don't know if you understand me.
Yeah.
If it is enough to drive price all the way down. If it's not enough, then it will drive it momentarily down, then retrace back and go for where there is enough orders that will drive it further down. So it depends on the amount of orders around here, institutional orders around here, that will determine how far this trade will go. And also it depends on the flow of what they call it, the higher time frame flow. So if you are in the direction of the higher time frame flow, you stand the higher chance of getting other blocks that are filled with orders that will take price down for a long time. Do you understand?
So more or less, price will just be moving from one order to another order block.
Yes.
One other block to another
That's
other
the way.
block.
That's the way price moves.
Yeah. So it's also a possibility that once it's moving in a particular order block, more orders can come in that direction.
Yes.
That direction,
yes,
correct?
and push you in that direction. Retailers can add their own orders and start pushing price down. You understand?
Yeah.
Because retail orders will also help in pushing price down after the smart money has sold to them. The only time it may not go further down is when at that point smart money decides to sell off all everything to the retailers and ask them to do with it whatever they want to do. So they will not have enough power to push trade all the way down. Do you have any other questions, sir?
No. So my next question now is, this is on the daily, right? This is on the daily.
Yes.
We've analyzed down to the daily. Now, you don't look for the trade. Most of the trades I see with the Q is intraday, like it's within the day. You close it and within the day. So So if you want to break down now, because before this now price will now come and price will come back to this other block, it's going to take a while, maybe 2 weeks or 3 weeks from this candle.
This is 247, yes.
It's going to take a while. So scaling this down, something that will execute within a day.
Something you will execute. Then you start looking at fractal structures. That's when you can start looking at this. Like now, you can look at this leg. What can happen within this leg? You understand? This is what is trending. And now go to 4 hours and see what the trend looks like. You understand? But you know that when you are trading this kind of pair, you should be looking at, you should be careful of not targeting very far, because there are multiple places where price can get back to. Like now we've seen one. I like the way your questions are going. They are really structured and it's helping the class. So you see this one. You see we've seen another one. So price is going to come before it even comes to this place. It's going to come to. I have an order here. Okay, this is Euro USD. The same thing is happening on GBP USD and NZD USD. Now it's going to come here. Then when it comes here, it can respect it a bit. So this thing now, you are not expected to start targeting all the way down. If it goes to all the way down, glory be to God. Do you understand me? So even with this one, this can be refined. You see the imbalance. I hope you're seeing the imbalance on this one.
Yeah, I've seen it.
So even with this, what do we have here? It's 19 pips. Without refining it. Imagine when I refine it to 1 hour, I could even get like 7 pips.
So Casey, let me ask you why you're there now.
Yes.
If I want to put if you bring your sell order now, and put it here now,
This 4
where
hours.
will now be your where are you going to put your entry now, and where are you going to put your stop loss? Is it going to be based on that imbalance? Or based on the refined order block?
It's based on the order block. It's based on the order block. Now I have taken this candle. This is my order block. If I want to make my entry, I will place my entry here. Now I can decide to just push it a bit down just to stay within the imbalance, because sometimes these guys can just fill up 50% of the imbalance and start going down. You understand? Just to say I don't miss it, then maybe just use, you can decide to use, this is how many pips? 23. I can just maybe make it 30. You understand? Because I know this is what price wants to come and take. If it takes here, anytime it breaks above here, just know that it's coming for the next one.
Yeah.
You understand? It's coming for the next available one. But what I know is that it will come here most times. Respect it a bit, even if it's not going to go all the way down.
Hello?
Yeah, do you understand me?
Yeah. I said that respect, that you can respect it, can even be like 1 hour.
It can be more than 1 hour. Let me show you something. Let me show you NZD USD or AUD USD. Let me show you respect, what I'm talking about when it comes to respect. Good. Perfect. You see this trade? You see where you see imbalances? You see the imbalance, see the trade, you see this one. This one is another one. Some students took this one. I want to take this one. You understand? Now look at, there some even took the one here. Last week we took the one. There's one here. If this is the imbalance here, but when we refined it, we saw it all above somewhere here. Okay, no, sorry, we saw it above here. Let me refine it for you so that you just see. So you don't think we are. Now, this is the first one. This is the first order block here. Are you with me? Hello? Whew, man.
Ah,
Can you hear me?
I can hear you.
Okay, now for this particular, this is AUD USD, abi? This is the first order block. This one I just painted. Now let me remove my, so that it stops reflecting. Hello?
I can hear you, but this one you drew looks so big.
Yes, now because it will always, you will always take the shape of the order block. That's what, you are not going to define it yourself. The market defines it for you. But when I see something like, is that?
Sorry. Just hold on. Withdraw. Can you just withdraw that other hair? Okay.
This is an engulfing pattern. Now we need to see it as an engulfing pattern. Now with with this, it's large. When I see something like this, I know that there will always be a refined spot. It's 4 hours. Let's go to 1 hour and see how it looks. Look at the 1 hour. You see the 1 hour imbalance here. All those big things you are seeing there. You see how it has been refined. You see the imbalance. Hello, sir. Did you see the imbalance?
Yeah, I can see it.
So you see that price.
Now came to them.
It came deep into it. It came deep into it. Now look at what I was saying. Respect. You see that immediately it took the imbalance. It started falling. Now look at respect. If you had kept your stop above here, 21 pips. Actually, it was 20 pips that we had. Look at this first fall to this point for that day was 2R. Are you seeing it? So if you decided to take your 2R from here, knowing that you have other imbalances above here, close some. You understand? Or maybe it came even when it gave you even at the close of, let me show you something. Even at the close of 1 hour, the first 1 hour, this thing. 1 hour candle. I hope you're seeing the 1 hour candle here. Hello, sir.
I can hear you.
Yes, even at the close of the first 1 hour candle, you were already 1 hour up. More than 1 hour. The first 1 hour. Now, you could decide that at this 1 hour, I will take out 0.5 and leave my stop here. Let me even see what this other block is. Probability we are working with. Let me see what this other block. Imagine you have left it and it kept on doing what it was doing, and price came, you see, after 2 days it came all the way to this point. 3.6 R, 3.2 R, 26 R. So this is the importance of refining your, if it was not for refining, if it was not for refining, you will be in serious drawdown.
You won't see the imbalance. Yes, you won't see that imbalance. And look at the imbalance is like half of how big the imbalance itself is half of the main order block.
Now that brings me to something. Before now, you know, as I'm getting older in trading, I keep refining my way. I'm telling you, it's just the way it is. The way I used to trade before is not the way I trade now. Now, I try to do things better than what I did last year or last 2 years. Now, before now, look at my concept. My concept is I get the imbalance, then I take half off. If some of the students have been with me for some years now will know that that's what we used to do. I will take it and take 50% of the other block. Sometimes it will work. Sometimes I will miss it by one pip, 2 pips. You understand? Now I now start wondering.
Okay. Okay, you now put it at 50% of the other block.
Of the other, that's where my entry will now be.
Okay.
You understand? Sometimes it will come to that my 50%, take it and come down. Some other times it will not, it will just miss it by one pip. And now, so the ones that miss, I take meticulous, what they call it, records of my trades, and I try to analyze them. Like this weekend now, it's not just, if not that I'm busy with teaching and all that, I take out my trades, every trade I take, and analyze it again and say, okay, why did it fail? What would I have done better?
Yeah.
So I now found out that, okay, for majority of those trades that failed, look at where they were actually coming to. Initially, okay, let me show you the transition so that you understand that it don't be today. The transition was, I was now beginning to, first I thought it was that they will come to the body of, if you check my demand and supply, what they call it, video, I'm going to update that video actually. You see, I tell you to draw it from the body of the candle, right?
Yeah.
Yes. Now, before I used to think it will come to the body of the candle, it's the body of the candle that it comes to pick the trade. It was now with further research that I found out that, okay, the ones that I missed, that I kept at the body of the candle, after I have exhausted my 50%, that's using 50% of the order block, I started using body of the green candle. Then I now found out that, okay, I don't want to be missing, because you find out that I will have, like, maybe I put like 10 trades. Then out of those 10 trades, 6 or 7 or even 8 sometimes will go in my direction, but out of the 8, I'm only able to, that only about 4 or 5 will actually pick my order. The other ones will now miss it by 1 pip. I say, what kind of thing? And the ones that will miss it by 1 pip will now be the one that will give me 10 hours.
10 hours.
I don't know. I say, what kind of witch is this one now? You understand? So I now started.
Yeah.
That's when I started researching and found out that, okay, this is actually what happens when the imbalance is created. Price comes to fill the imbalance. Immediately it fills the imbalance, it comes going. So my target now is on the imbalance, but my stop will be above the, yes, my stop will now be above the order block. So I want to make my entry somewhere within that imbalance.
Balance.
Do you understand what I mean? So you see the transition now.
Perfect.
So now this is the imbalance now. Let me remove this line. This is the imbalance. So entries will now come somewhere. You see how the entries came? Maybe somewhere here. Knowing that it will come to fill up that imbalance. Then put my stops above and let it come in. Sometimes I will just take the whole of the candle, just where the imbalance stops. You understand?
Yeah.
Mm-hmm. But I know that it will always come for that last imbalance. Now there's something that happens. It's called the fractal structures. I'm studying it. I want to be, by the time I'm done with it, I can categorically say, okay, this is why this happens. Now if you look at this, I'll show you. I'm still on the studio. It's not I can't say when I backtest and I'm done, I can now say, okay, because I like to be a little more, yes, there's nothing that is 100% sure in Forex, but I want to at least have reasons for doing what I'm doing at all times. Do you understand what I mean? Reasons for doing. Now, I also found that, like, you see, this is the whole imbalance that price came into. I found out that it will start creating, there's something called the Y curve structure inside the fractal structure. It will start creating the fractal structure inside this order block. And most of the times, if you know Y curve, most of the time the test, they call the test, or you call it, or the spring, usually is almost at the last point of the imbalance before it starts falling, like this and this. Then before it starts falling well. Now, another, then a bigger Y curve structure will now start happening when using a combination of, like this one, you have a combination of other blocks here. It will keep doing this. It will get to this point 4. You see that this other one, the people that traded it yesterday, this is the one Harley traded. Harley and Freedom. They traded this one and it fell up to this point. So anybody that took this trade at this point, the refined form, because I think we had the refined form that came up, would have been in above 1.5 hour, even in the scarcity of trade. You know, the scarcity of trade now, actually the market is not really moving the way it used to.
Yeah.
So you would have been in 5 hour. Check the 1 minute trade that Harley posted. It was still the same thing. So it's the same across all time frames.
Okay.
So I think we touched entry a bit here. We've also looked at analyzing the pair from the monthly down to 1 hour, based on your questions.
Yeah.
So I'll go back to where we were on Euro USD, right? Yes,
Yeah.
yes. I just came to AUD USD to just show you what actually happens. If you check, this one also played the same card. It came to this other block here. There's another block here. It fell. So if you are taking trades, a minor trade here, same thing. Same thing. Same thing. This one is.
But now I have. Sorry, Casey.
Yeah, go on, sir.
So my concern now with smart money trading,
yeah, okay,
or smart money concept, is the fact that, you know, in normal retail trading, sometimes you can keep the trade and allow it to run on another for a long time.
Mm-hmm.
But with the idea of fractals, you know, in just trying to marry between pips and risk to reward ratio, you know, the idea of fractals, you can actually, when you do marry, because of fractals, you can see in one day, like you can see a 2 hour, 4 hour trade, 10 hour trade, within a day. So that will now imply what I'm trying to drive is the fact that you might need does it need more timing now to sit down for you to now, before you can now get those big values.
No, it doesn't.
Whereas in normal retail trading, you gives you time, you can just place the trade and you then go and rest.
No, it doesn't. This is even better for you. A retail trader most time want to wait for confirmation. 4 hours confirmation. That means you are on your chart waiting for the close of 4 hours. Now what I do is, you on a weekend like this, I would have analyzed my pair, refine this other, like we've seen the other block. This is my entry zone.
Yeah.
Candles are not moving. This is my entry zone. If I refine it to 15 minutes, I know once I see the imbalance, I'll place my trade and go away. It's not left for me on my kind of personality whether I want to leave that trade to go all the way down or take partials.
Okay.
You understand?
Okay.
There are pictures I will show you on smart money concept. You see some people hitting 100 hours in 2 weeks. Forget. You know the thing. See, whether you are waiting for 4 hours close like this one, like retailers will wait for this kind of close, abi, and make entry here. Whether you're waiting for 4 hours close, or if I enter here, the price at this point is what? 1.6629. Whether it is a 4 hours close that gave 1. Or 2 hours close, price is price. So me entering at this point is advantage. Now if price ever wants to retrace back, do you think, is it not this guy here that is going to take out? Which one is a better entry? He will take out this guy on break even first. He may even come here, take out this guy on break even and still leave me. That's why I like to take, you see, this kind of trades, this kind of zone. These zones like this most times are what they call it, they are major, like the daily demand and supply zones. They are usually major zones which can lead to a prolonged what they call it, trend. Let me show you one example, because I like to use examples on the chart of trades that had happened in the past. Euro Australian dollar. I'm actually waiting for another trade here. Now you see this trade. Oh, sorry, I have a lot of markings here. I was using it to teach somebody. You see this one? This is an order block here. This one is another order block here. I have colleague that is here. He has been on this trade from here to this point. So check it. This is about 300 pips. I can show you the picture. It's not as a real life trading. It's not drama. You understand? Now imagine you entered here and place your stop here. Sorry. And place your stop here. Why am I able to come back to it? Because I know the history of this trade. I know when we were talking about this trade, I wasn't too keen about the trade, because we usually would analyze. Imagine at this point, see what it is, 8R. That is if I put my stop. See, it's 8R. And how long has it taken to get to 8R? I don't think it's up to 2 weeks. Sorry. Let me use the date range. Oh, I have another class. Sure, I said it was going to be 2 hours.
You know me, I don't like. No, but at least with this one now, I should be putting up trades this week on my demo. Like
yes, you need to try out. And I am happy I have it recorded also, so that I can share with other students. They watch. I like your questions. They are very structured. So look, I took 9 days. You understand? To make 8R.
Yeah.
On just this, which is awesome. If you had risked 3% on this trade, you're already 3 times 8, 24% up.
Of your account.
Yes, of your account.
Yeah.
So you see, that's why smart money guy can just maybe risk 1% of his account.
Yeah.
You understand? Why the retailer wants to risk 3%?
Yeah, exactly.
Wants to risk 3%. What are you doing with 3%? Do you know what it means? If you're risking 1% of your account on a fresh account, it means you have 100 trials. 100 solid trials. Are you with me?
Yeah.
You have 100 solid trials to make money from that account. But if you're risking 3%, you have just 30 trials.
Yeah.
Talk more of people that are risking 10%, 20%. You just have 5 trials, and there's no certainty here. So you stay longer with this.
Yeah.
So I hope this answers your question. Okay, now look at the next one. I'm looking at, there are 2 possibilities here to this point. Here to this point, now this is something that makes it even amazing. Imagine someone that took trades from here, up to here is 8R. Then I'm taking the second point up to here. If it gets into me like this and this one holds and comes all the way down, is 16R.
Because of the way your stop loss is.
Yes, but now believe me, what can happen is that this one will come, fall down a bit, because I've refined. See, it was a 4-hour order block. Let me take it up. Sorry for the writings. I was trying to teach a newbie how to count pips. Now imagine it was a 4-hour order block, but I've refined it. You understand? Which it's going to come here. If it comes here now, it can respect it a bit. If it gives me 2R, I can decide to break even or take out some profit and leave it. If it keeps falling, it's to my advantage.
Yeah.
Now this is another point it will come to. It can decide to fall a bit, then come for this one. These are the 2 points I want to take this trade from. So now it conditions my mind not to over risk, because I have hope of another trial.
Yeah. Another trial.
Why do people over risk? Because they feel they will not get another trade in the nearest future. No, that's not the way smart money works. You know that if this fails you, the next one can give you a massive return to risk to reward ratio that will cover your loss.
That will cover.
So you are not.
So you are better off trying to even split up your trade itself. Like
yes.
Split your risk. Yeah.
Yes. Now you now split it across several pairs or different pairs. If you want, maybe you choose like 3 pairs in a week and split it across them. Now, when we get to risk to reward ratio, there are things I'm going to show you how to approach your week based on risk. How to approach your day based on risk. How to approach a trade based on risk. These are rules that you need to keep to be profitable. What we are talking here is professionalism, not gamble.
Yeah.
So, sir, I think we've done justice to today. We'll continue in the next class where we'll talk more. Maybe we'll talk more of executions, then talk about risk, what they call it, risk management and trade management. But I believe with this, you should be able to start entering trades on your demo. Back test, forward test these things and see how it works.
This your trading view account, is it premium? Is it paid?
No, it's free.
Okay.
It's free.
How what's the time this that they allows you to do? Does it allow you to come to the second time frame?
No, I can't go to the second. It's to the minute.
And you cannot use replay mode, right?
You can use replay on the daily upwards.
Okay.
You can't use replay from 4 hours down.
Okay.
So I can't replay 4-hour trades. I can replay daily trades.
Alright. Okay, that's fine. No, I should be able to start kicking up with you guys this week.
Alright, sir. I want to see you active. Now, another thing, just before we go, you see that this is a trend line. You see that this is a trend line. It's going to want to manipulate this trend line. This is where the retailers will want to take their entry.
Yeah.
You understand?
But bad money is looking at the other block.
He's looking at the other block. So when they come, they will put their entry here, put their stop here. Small money will go and take the stop and still sell.
Now,
Are you with me? And
hello?
Yes, hello. All right, sir. Hello?
Already?
Hello?
Yes.
Can you hear me?
Hello?
Yeah.
I can hear you.
All right. So that's the way it works.
This at least I should be able to analyze quite a couple of charts now.
All right. That's awesome. That's awesome. That's what I really want to hear.
Sure.
I even have a fear that he may even want to come to do this, guy. I even have fear that it was. No, it will come up. It will do this once more, then come up. I don't know, sir.
So when you are taking, sorry, just to refresh, when you are taking your order, do you take it from the wick to the middle or the entire candle and start refining?
No, I take the entire candle, then start refining inside. And now I want to be taking the entire. Before it was the wick to the middle, but I want to take the entire candle, then start refining it all the way up. Keeping the upper limits.
The upper limit constant.
Yes, that's if it's a sell. Then if it's a buy, keep the lower limit constant.
Okay. Okay.
All right, sir. Thank you
very much.
Yeah, for attending today. I hope we're able to get something.
Sure.
All right. Thank you.
Sure. Thanks a lot.
You're welcome.
Thanks.
Oh shit.